clearly, we're all kind of still kind of coming to realization of what happened, and all the energies that were spent over the past few years just trying to resist. Hopefully we can subside some of those negative energies and can now focus on actually building something and delivering value that attracts the institutional attention, which has been lukewarm at best. So what I want to kick off the panel, and the questions for the panel with, is how do we get institutions? First of all, before we even get to that, why don't we take a stock of where we are? We want to understand where we are in the journey of institutional adoption, specifically understanding participation that is retail versus institutional, and defining what each of you mean by institution. If you can define what that word means to you, institution. Ophelia, you want to go first?
Sure. I guess I can kick us off. Now,
Yeah.
my business, so we run ETFs and ETPs, both in Europe and in the US, as well as in Australia. And we've been doing this for about 7 years. What we see in institutions of people who actually play in this space, you see a lot of private banks, you're starting to see some asset managers. You see a lot of hedge funds that are mostly coming in to trade basis against the futures products. You're seeing a little bit of enhanced institutionalization where you're starting to see some larger asset managers and banks start to allocate, but it's really early. And honestly, you don't really see much in the way of advised accounts almost anywhere. You see a little bit of retirement savings, especially in the German markets. You see a little bit of that starting with RIAs in the US, but it's still quite early from that perspective in terms of seeing real institutional adoption in the way I think TradFi would define it. I think when we talk about institutions, we have a tendency to mean not retail and lump all of that together, which is not, in my experience, how traditional financial markets structure that delineation.
Completely fair.
Yeah, I can add to that from the standpoint of institutional. Not every institution is the same, and every as we segment the institutional market, there are institutions that invest as principal for their own portfolios, and that would include the hedge funds of the world as well as pension funds. And we've seen from 13F reports on holders of the crypto ETPs that there are a handful of these true institutional investors that are interested in the crypto space. Not to the extent of, I think, our prior panel, getting deeper into the diversity of the ecosystem, but largely focused on the largest and most liquid of the crypto assets, that being Bitcoin and Ethereum, which is what we see in the ETPs today. For retail, from a Fidelity lens, we think of retail as individual investors, and we have a platform that provides brokerage services, but also education for those individual investors to be able to manage their own brokerage accounts.
Oh, that's great. Ben or Chris, I would love to explore the cash versus ETPs, kind of what you Cynthia and all mentioned. Are you seeing ETPs giving the reason for the institutions that are sitting on the sidelines to actually come in the thing, experiment a little bit, and then get comfortable with the other assets, kind of thing? Yeah. Chris?
So institutions will take market risk all day long. That's why they get paid. What they don't want to take is regulatory risk or operational risk. The beauty of the ETFs, ETPs, is that you kind of take that off the table, right? I want to invest in Bitcoin. I want to go into my brokerage account, and it's going to be just like any other equity. I know the wrapper, I know the regulation, and the operational risk. Don't even have to think about it because it's just plug and play.
Right.
Alternatively, if you're going to invest in a crypto native asset, you're going to need to have custody. You're going to have to understand how to navigate DeFi. It's much, much more complex.
Yeah.
The good news is that, if you look at ETPs or ETFs, that's the old world, and it was a very clear, just a very clear path for institutions to enter the market. And yes, the ability to enter the market is limited to, like, in the U.S., Bitcoin and ETH. But now, after these elections, I do expect for that regulatory de-risking to happen, and that regulatory risk is going to come down. That leaves you with operational risk, and we're venture investors. We've been investing in infrastructure for the last 10 years, and as those things come together, I think you're going to see institutional adoption for the rest of the asset class. The thousands, the tens of thousands of tokens now come into play. Now, some will have value, some will not, but that's going to be a major unlock as the regulatory risk comes off.
Yeah, I'll jump in there a bit. It's just kind of taking off on a slightly different tangent. If you look at institutionalized, not retail and not high net worth, let's call it that, we're focused on a lot of treasury management for protocols, and that's for us a very large part of the business, a very large part of this ecosystem, and that's something that we focused on before. We have seen kind of some of the corporates outside of protocols pivot into the VC space, corporate VCs. We see a lot of, like, for example, Japanese corporates jumping into Web3, metaverse, and so forth. But outside of that, outside of these special kind of venture type investments, we haven't seen as much. And we're hoping over time that they will adopt to more of that. But our focus, we've decided to focus really on that area. And the other area, which I think people don't talk about as much, is we're also looking at working with the government, because the government actually has a lot of crypto assets. So that's certainly institutional from our perspective.
That's so interesting. That's the opposite of what we see in
Yeah.
Europe, in a really fascinating way. So Switzerland, which is actually where we started the company, has had like regulatory clarity at the token level for the last 10 years. They decided they wanted to be Bitcoin nation. They did a wonderful job of doing that. They set up very clear regulatory infrastructure like 8-9 years ago. It's been remarkably consistent. It gets updated. It makes sense. Everybody's happy. That's great. One of the funny things that's come from that is you still don't see institutions holding coins directly, because they still don't want the operational risk of, does my ops team really know how to settle this? There's no central clearing. I don't know who these people are. How much due diligence am I really willing to do on trading counterparties? Like, they don't really do that much of it. They still prefer intermediated access, because essentially they see it as paying a small fee to not have to worry about this. And they're essentially paying, in this case, us, to do that for them. And it's not just from a risk mitigation perspective, it's also just from a effort to dollars basis. If your clients are going to allocate somewhere between 1% and 5% of their assets to crypto, how much time and effort are you willing to put in to build operational infrastructure to support a small percentage of clients' portfolios, when your primary business is actually really making your clients money and or raising more client assets? And so we've seen that they continue to want to outsource that in a much more similar model to the way we would think about asset servicing. They just don't want to build the infrastructure to do it, and legacy infrastructure is not really compatible, and it's 1% to 5%. Great, pay somebody 20 basis points to deal with that for you. Seems to be a much more common logic tree than I would have thought, even in places where they do have that regulatory clarity. And we've seen it. And for example, in Europe, some of our most popular funds are things like Solana that have been around for years. And most people assume that's going to be a niche exposure, but we're running $1 billion Solana exchange traded product that's several years old and stakes, and our clients love it. And they're buying more of it, and it's growing at a really healthy rate. And I think that's something that people don't realize, is that as I think that educational curve, we see a lot of our clients come in as, a Bitcoin client, learn about ETH, become an ETH client, learn about both, become alts clients. And we run about 53 different funds covering all sorts of different alternative assets. And, we're running a $60 million SUI product that we launched in the last few months. Yeah. And it's just I think the user behavior that we've seen has been different than I think what most people would expect for the state of the market. We just see a lot more proliferation in people's exposures.
So you said a couple of really interesting things that absolutely we're already seeing here in the U.S. in terms of institutional adoption. And the first was, and Chris said it as well, right? The operational support for custody and for trading. And so traditional back offices can't handle any of the crypto needs for how these assets trade and how these assets will settle, and what does custody even look like, right? And all of the considerations around managing custody, which is why the brokerage wrapper and the brokerage product as a way to be able to get access to a crypto asset is so incredibly important in order to introduce institutional investors to these assets and what they can represent in terms of value and in terms of what the broader ecosystem is growing. It is still early days for assets beyond Bitcoin and ETH from the standpoint of market cap and liquidity. As we think about building out an active asset management organization for this ecosystem, research and data and analytics are going to be big differentiators in order to continue to look for portfolio construction ideas around being able to deliver value on exposure in this ecosystem.
Enterprise operational technology takes years to build.
Yeah.
Right?
Yes.
These assets, Ethereum's not even hasn't been in the market for 10 years.
Yeah.
Everything else is less than 10 years old. Most of these assets are less than 5 years old.
Yep.
So it's very hard. I do think
Oh, and by the way, they're not all the same.
they're not all the same.
Right.
But I do think in time, the operational stack is going to catch up. Why? Because we're moving to 24/7 markets across traditional finance and crypto native finance, which has always been like that. So the infrastructure must be upgraded. And I do think people don't have a choice.
Yeah.
And so it's going to happen. It's just going to take time.
And I think one of the things we talk about a lot internally is this idea of converging infrastructure.
Yeah.
Maybe this sounds like a little far out, but my perspective is that for now, these wrappers are great, and the ETFs will continue to bloom and do well, and the ETF industry will continue to take share from the mutual fund industry. That transition to what we're all talking about as antiquated tech hasn't even concluded yet from an institutional adoption perspective. Like ETFs are still setting every year record inflows, year over year, record inflows, trillions of dollars in assets locked into these structures because they're still growing and they're still taking share from mutual funds. So that technological shift of mutual funds to ETFs is still in progress. What comes after that, I agree, is likely a shift towards tokens. But between the way in which we do brokerage and the way in which we will abstract that infrastructure away, I don't think anybody's even going to notice. Aside from things will be cheaper, faster, 24/7, they'll have a better experience of it. But in the same way, I mean, how many people in this room really know how an ATM works?
But I think that's an incredibly important point, is that individuals are not calling up asking for a digital asset. They're calling and asking for help to manage their financial lives, and so all of the infrastructure and the access and all of the operational support is all happening on the back end. When you get your brokerage statement and you look at the assets, do you know and do you care whether or not those assets are held in DTC street name? Are they held in some certificate in a vault in a bank? That's what all of this infrastructure is going to be abstracted away from. People care about what the actual financial exposure is and how that helps them in their financial lives.
Yeah, to a certain extent, I think this is also what we're doing. So I'm actually in agreement with what you're saying in the sense that a lot of the corporates and the protocols that we're managing, we take away a lot of that operational layer that they have to do. So we're doing it in a more customized format, but I think it is the same thing. So
I agree. I think, and I think we're all saying flavors of the same thing, which is ultimately getting how you get access is not the point.
Yeah.
A lot more of the conversation needs to be centered on what it is you're getting access to.
And why?
And why you want that in your portfolio. And I think that's mostly from the interactions I have, I think that's mostly where institutions are at. At this stage, it's a lot of, CIOs' offices deciding what should that allocation look like? It's perfectly fine if the number is 0, but you can't say I don't have an opinion. And that, I think, has been the biggest change this year. It's not acceptable for investors who are managing assets on behalf of clients, when clients ask, to say, I don't know. You need to say something. There needs to be content in the box.
I think there's another risk, and that's reputational risk. And when I was on Wall Street, and I got the Bitcoin and Ethereum futures approved, I had to go through scores of approvals, and then I had to go to the reputational risk committee to say, what are we going to do to put our franchise at risk? Now that narrative is shifting, and the question is what's the reputational risk of not being in these assets? What's the reputational risk of not being in an asset class that's now going through a period of regulatory de-risking that also, prior to that, was the best performing asset class in the last 10 years? That narrative, I think, is going to start taking hold at institutions.
So this is amazing. I can just sit back and let you guys talk and absorb all the things that you guys are saying. So the path, am I hearing you from what I'm hearing from you is that one, it is not about whether you should be or should not be in this asset class. It is like, what is our game plan to be in this asset class? And there are various ways to participate in this asset class. If you were to bet in terms of institutional adoption, and this time I'm talking about institutions beyond who are early adopters and who are more than just hedge funds or family offices or some private bank allocation kind of stuff. For them, do you see the path to adoption through ETPs first, eventually into the underlying crypto, or do you see crypto adoption first and then combined with the ETPs, ETFs, and stuff like that? How do you think the adoption happens, especially given the infrastructure issues that you brought up and the readiness for them, but while they cannot wait, given some of the developments going on in the market right now?
So maybe I'll start by saying it has to start with education.
Yeah.
It has to start with a motivation as to what the asset is and why it matters before there will be any effort around what is the operational support necessary and what is the exposure. So a lot of where advisors are saying, well, how much? I think the right way to start that line of questions is why, right? Which is, what is the asset? Why should I care about it? Why should my clients care about it? And then from there, understand and have a view on what the valuation model of that asset is and how it fits into the portfolio. And that is, right, the journey that we're seeing more advisors on is starting with the question of what is it and why should I care?
If you want to take sort of a forward look on that, and I completely agree, I think that's very much today where the US market is. Yeah. What's really interesting is that's where the European market was 5 years ago. And so 5 years ago, I used to walk into meetings at banks and 7 years ago, and people would actually ask me if I was absolutely sure this wasn't illegal and I wasn't going to end up in prison somehow for the fact that I was building cryptocurrency exchange traded products. They're like, there's no way this is real. Do the regulators know about you? And I'm like, well, actually, yes, they do. This is fine. But what was really interesting is you went from that to a very intense phase of education to beginning to see allocations, and they typically center very heavily on Bitcoin. And you're already seeing a little bit of that in the US in terms of the relative performance of an asset gathering of US Bitcoin versus US ETH spot funds. And then they start to progress down this journey. And we've had clients who came to us 5 years ago saying, can you explain to me how blockchain works? Who are now like very actively engaged in DeFi. And it's about like guiding your clients through that arc of their journey. It all starts with education, but what the goalpost of education is keeps moving forward as the clients work their way through their own trajectory. And we've had quite a number of clients who came to us originally asking about what's a blockchain and can you explain to me the Byzantine general problem and why this matters, who are now doing things like asking about relative valuations of NFTs or how to think about, self-custody relative to centralized custody in the context of the types of assets we don't cover. And we've seen them use our products really extensively alongside physical assets. So they will have their own Coinbase accounts and they will have their own wallets. And then they will also use ETPs as part of that strategy as another form of almost like a deep cold storage. Mm-hmm. And so people actually look at their risk allocation is actually based on that. And they have risk guidelines around their allocations across the different product formats. It's quite interesting. But I think that's the end state, given sufficient time to get there, which I would assume is from what I'm seeing, 5+ years in the US probably. But I think that's where we're going.
I think there's going to be an opportunity for a lot of synthetic products as well, because we talked about regulatory de-risking, we talked about operational risk, and it takes a long time to build enterprise. So there are plenty of synthetic products that you can leverage. I think one of the issues with institutional adoption in the US, and globally for that matter amongst banks, is Basel. Basel is holding us back. That's going to take some time to work out. But there are plenty of other ways you can get exposure to the asset beyond just an ETP. Synthetically via NDFs. There's an entire fixed income market that's about to be born through rates, perp funding rates, staking rates. Those are some other very exciting things that could be additional gateways for people who don't want to worry about the operational infrastructure.
That's fantastic. Now, one of the questions that I tend to get asked all the time, and I'd love to kind of get your take on it, is, what is the above and beyond some of the use cases or benefits that have been touted about the bigger liquid coins, the Bitcoin and the Ether and stuff, which is store of value and macro hedge and maybe smart contracts and some of these things. The question is there something real tangible world assets that can come on to the chain that can really take the value not from the 1 trillion and 2 trillion kind of the value locked kind of thing to something lot bigger? Do you see real world applications coming onto the chain and changing giving a reason for institutions to connect the logical side of the brain with the artistic side of the brain?
Look, it comes down to utility. Let's look at stablecoins. Really exciting place. About 200 billion in market cap right now. Not that exciting. It's kind of small if you think about it. But what utility do they provide? Payments. You can pay anyone in the world instantly, very, very cheap. The second application that nobody talks about is collateral. We have hundreds of billions of dollars that go through the system every day to support derivatives and other asset classes and collateral. This reduces things like Herstat risk. And the last one, maybe the most exciting one, is FX. That's a $7.5 trillion a day market. I'm going to venture to guess that internet money is not going to be 99% US dollars, right? Today, much of FX trades T+2. Wouldn't it be better? Wouldn't the world be a better place? We had a bank go bankrupt in 1974 called Herstat. Let's get rid of it. And you can really eliminate settlement risk, accelerate that market. It's already kind of decentralized. That's a really interesting market to watch out for.
And I would add access to dollars. The minute you look beyond the US, access to dollars is actually a very big deal, and access to dollars at a real exchange rate. So not just FX markets on the banking side, but actually FX markets on the consumer side, and reducing the spread between those two things is ultimately a major win for especially a lot of developing economies where you tend to see large deltas between official and unofficial exchange rates.
That's very interesting. Look, we are sitting on the cusp of literally a transformation that either US rides on that wave or falls behind. We have, abducted that responsibility up until to other jurisdictions up until now, hopefully. But do you think what role US can and should play with this new administration that is about to come in, and what is your take on some of the political developments that can unleash finally the power of to the institutions that is long overdue?
Goes back to the reg risk question. If you can remove regulatory risk because you have clarity, it removes a lot of the obstacles to people being able to use this technology. The US has a tendency on a global basis to be a leader when it comes to the way in which financial regulations are written and enforced. Not the least of which because of the dynamics with SWIFT and the way in which America has a tendency to lead the way and or impose to some extent their regulatory view on other markets. So I think you'll see a pretty wide global unlock on the regulatory front with an administration that's going to be friendlier towards crypto and more likely to provide some clarity, especially if you start to see some changes in the agencies around that. And I would add to that, I think you will also see a change, I think, in the attitude. It's much easier to get things done if you know where you stand. Can't be underestimated.
Yeah. Chris?
I do. I'm sorry. Go ahead.
No, go ahead. Okay, I'll jump in. I think the regulatory question, getting clarity, would really move things along, and just kind of talking about a personal peeve, I guess, if nothing else. I think a lot of issues that I'm facing when we're facing this industry also is somewhat tax related because of the U.S. kind of global taxing regime. So, and this is not a crypto problem. In TradFi, most financial products are created as a U.S. and non-U.S. version, and that split is not due to regulatory. That split is due to taxes. So, I'm hoping that by adopting crypto technology is a way to kind of overcome that. I've not found the answer. I'm just stating it as a problem, not as an answer, but it's certainly something I'm looking for and hoping to find solutions, because I think right now the global liquidity pool is split because of that, and I would love to unsplit that. I think there's a lot of value in that.
Yeah. Agree with that, and maybe what I would add on to Ophelia's point earlier is that innovation in financial markets has historically and traditionally been led by the U.S. and this is where the last several years of being stuck in more of a holding pattern, I would say, compared to the rest of the world in terms of developer activity, being able to bring actual use cases to market. And we see this not just in Europe, but in Asia as well. Now the U.S. is feeling a little bit less right at the front foot of innovation, and maybe now coming a bit of catch up.
Yeah. Innovation, leadership, these are fundamental American bipartisan values. That's why you saw 71 Democrats join Republicans on the market structure bill. The sleeping giant is waking up. Mm-hmm. We will lead. We have the deepest capital markets in the world. This is an intersection. If you step back and you say, hey, name a humongous, successful Web 2 company outside of the U.S., there aren't that many. There are a couple that'll come to mind.
Yeah.
Now, and where are the deepest capital markets? The U.S. Now we're going to take the internet innovation and marry it together with financial innovation. This is the rightful home for leadership. We've got the deepest talent. What we've been missing to date is clear, predictable regulation that really defines our marketplace and our capital markets. That's coming. I'm incredibly bullish. The other thing, crypto is instantaneously global. You release a protocol into the internet, everyone can access it. That's why it's so imperative that regulation is consistent. It's not going to be identical. And I think when I discuss policies with other governments, they want the U.S. to lead, and they want to cater whatever's unique to their jurisdiction based off of the U.S. leadership. So we saw that in Dodd-Frank. I think we're going to see it again.
And that's how most capital markets regulations work. A lot of them are framed off of, there's really only a couple of global frameworks that most markets base themselves off of. The biggest one is the U.S. Most Asian capital markets are in some way based off of 33 and 40 Act structures. It's very hard to do much without that U.S. leadership because those markets are not structurally set up to decouple completely from the U.S. regulatory infrastructure. So they're in a holding pattern.
Yeah. One last question. We have 15 seconds. Who gets to lead the crypto regulation in the U.S., CFTC or the SEC?
CFTC.
CFTC.
I'd like it to be CFTC.
CFTC. You like it to be. Yeah. Well, but what do you think? Who leads?
I don't know.
Cynthia?
I don't really actually have an opinion on that one, other than we would like to see clarity from an agency that is properly funded and properly staffed.
That's awesome. Chris?
I agree with Cynthia, but I think the CFTC is going to have a much bigger role.
Much bigger role. There you go. With that, panel, I wanted to thank you, each one of you. Thank you for an excellent